Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris L. Joining me in studio this week from Motley Fool 1, Jason Moser, and from Motley Fool's $1 Million Portfolio, Charly Travers and Ron Gross. Good to see you guys.
Hey, how you doing, Chris?
We got retail stocks, we've got gaming stocks, we got the 25 best companies in America. We'll talk about the future of Ford Motor and the automotive industry with best-selling author Bryce Hoffman. And as always, we got a few stocks on our radar, but we're going to begin this week with Groupon. Shares were down more than 20% on Thursday after terrible fourth quarter results, but they bounced back Friday morning after CEO and founder Andrew Mason was fired late on Thursday. And Jason, Andrew Mason said as much in his farewell letter. He had to go.
Yeah, and that was a good farewell letter. I mean, I think it was probably the most effective communication we've seen from him thus far.
And included a joke. You don't usually get a joke in a resignation letter.
He really showed his true colors there, some humility and a good sense of humor. But, I mean, this is something that obviously needed to happen. I don't think it's a surprise that it happened, especially given their core. But I would also warn investors to please not be fooled into thinking that just a leadership change makes everything all better here, because you still have the same underlying problem in a company with really no distinct competitive advantages in an industry that has virtually no barriers to entry. And so the leadership change is one change of probably many that they're getting ready to to put forth here, and I think this is just the beginning of it.
Yeah, and Charlie, speaking of the underlying business, I mean, just to go back to those fourth quarter results, they lost $81 million. They forecast flat sales, margins are shrinking, cash flow is declining. Is there any?
But it rhymes with coupon.
Yeah, it does rhyme with coupon. That might have been the best move they ever made. It's kind of
waiting for a bright spot out of you there.
I was actually going to turn it over to you for any silver lining in this
Ray
business.
Of sunshine.
I think that they do have a well-known name and brand. I do think they have a large number of users, but I think they need to tweak the business model a little bit. The economics of these deals are not that great for merchants. There tends not to be a lot of repeat use because of that. If you have a restaurant and you're selling your dinner at half off and you only get to keep half of that money, that's a losing proposition unless you get to keep those customers who tried you for the first time coming back for more. So maybe they can introduce some loyalty elements to get that kind of repeat business. But something's got to change other than just the CEO.
What do you think, Ron?
I think the IPO was a real shame and left a lot of people holding the bag. It went public. I'm sure at the time we were all over
market cap of $16.5 billion when they went public, and now it's around $3 billion.
Right. And in a sense, you can't fault the company for trying to get the best valuation they can in the marketplace, but with the weird metrics that they originally put forth that didn't include those marketing expenses,
right.
All that kind of stuff. It really was just a shame. It's the kind of case where the IPO markets really don't work for the individual investor, and that's why everyone really should be careful about what they're buying if they're kind of lucky enough, in quotes, to get in on IPOs.
And it's not terribly surprising that they have not been successful thus far. I mean, you can look at Amazon's quarterly reports, and they continue to write off this Living Social investment, and Living Social just they recorded a $650 million loss over 2012. So it's just not the most lucrative, defendable business model in the world. Now, with that said, Charlie, I think, said a very important word here in loyalty, and I think let's try to come up with some ideas of how Groupon can get better. And I think one of the keys there is to try to figure out a way to develop a more loyal following, sort of a stickier consumer base. And I think it would be important for them to be able to partner up with someone in some regard, whether it's a Visa or a MasterCard or an American Express. And we've talked before about American Express and their deal with Twitter. And I think that's a great example of just something that Groupon could pursue in order to create a little bit more of a loyal customer base, keep people coming back for more.
This week, New Jersey became the biggest state yet to allow regulated online gambling. The new law signed by Governor Christie allows casinos in Atlantic City to run websites that take bets on poker, blackjack, and slots. Ron, last week it was Nevada passing this kind of law. This week it's New Jersey. It kind of seems like it's one of those situations where the dominoes are just going to start falling in terms of the states. And we saw stocks rising sort of across the board, not just the casino stocks, but even Zynga was popping on this news.
I think this was inevitable. It was going to be the next iteration of gambling. It had to happen at some point. The major holdup was the Department of Justice, which starting really in 2011 began to signal that they were going to lighten up on this. There's still a lot of hurdles on a state-by-state basis. Gambling still has a stigma that is negative to many folks, but it's coming, and it is definitely the future of gambling. And there's going to be a lot of winners, whether it's the technology companies, the social gaming companies, the casinos themselves, even the Indian tribes that run these casinos in a lot of jurisdictions. A lot of people are going to benefit, and the 15% tax that New Jersey is going to collect on all this additional revenue doesn't hurt either.
But are some companies in better positions than others? Because just on the face of it, it would seem like it would be the casinos themselves, because they already have the apparatus in-house to deal with state regulators, and that is a whole side of the business that obviously isn't glamorous and doesn't really, make them any money per se, but that's among the most crucial part of the business. And if you're Zynga, yes, you have the opportunity to now go into gaming stocks, but you now all of a sudden have to build from the ground up a state regulator department within your business.
Well, I want to say yes. I think you're exactly right. The casinos have the infrastructure in place to get this done. Now, Zynga does have, for example, 15 million online poker players right now that are not playing, not gambling. It's games. You can probably convert a significant amount of those people to be actual gamblers. But again, you're correct when it comes to the regulatory issues.
Charlie, you're the best poker player in the room. I turn to you.
With some of the scandals that have come around with the poker gaming sites, I agree with Ron that the casinos are the winner, because it's not just the infrastructure and dealing with the regulators. It's a matter of trust that the site is not going to steal your money. It's a matter of trust that the game you're playing is actually fair. The odds are still stacked against you, by the way, but at least it's fairly against you and they're not cheating. So I think the casinos are the winner here.
Best Buy's fourth quarter loss came in lower than expected, and shares were up a little bit Friday morning as a result of that. Charlie, one of the narratives we've seen playing out over the last few months is Richard Scholes, the founder of Best Buy, really trying to take the company private, looking to line up the financing to do that. And separate from the quarterly results was the news that Best Buy rejected his latest offer, which was just a $1 billion investment. When you look at Best Buy, what leaps out at you?
Sure, Chris. Right. So last August, Schultz proposed acquiring the company for $24 to $26 a share. It's at $16 right now. The deadline for his...
Take it. Take the
right.
bid.
You take the money if it happened, and he does own 20% of the stock. But the deadline to buy the entire company did pass without an offer, and the suspicions are that he couldn't get the financing. But if you look at the company's operations for the year, revenue was flat. Their comps were down a little over 1%, which actually isn't that bad considering the business they're in and who their competitors are. And the domestic was stronger than the international. They mentioned that Canada and China were weak. So there are some bright spots for Best Buy. Online could be very interesting for them. They're seeing double-digit growth in computing and mobile phones, which are no doubt what people are buying these days. And what's bad is consumer electronics and entertainment. They face a lot of competition, not just from Amazon, but from Walmart and Target. Cutthroat pricing there. So I think all in all, Best Buy is actually still making money, and it's not all doom and gloom. I think there are some bright spots in this report.
Jason, I have to believe that some of their locations are much more profitable than others. Is the path forward for a company like Best Buy just to get smaller as quickly as possible, to really focus on the ones that are more profitable?
I think it's going to have to do that. I mean, and certainly I'd be very concerned if they were opening new stores. I mean, what we're going to see probably for the foreseeable future here is some serious gross margin pressure, because with the price matching initiative, they're not going to really have any choice but to go ahead and sacrifice profitability just to keep their head in the game here, really. But yeah, I mean, focusing on the more profitable stores, and I think they're just going to really slim down the operations. It's kind of they're sort of, you're seeing Radio Shack kind of fall off the world here. Best Buy is going to sort of probably squeeze in there, take some of that space with the mobile phone business. The problem is that's not the most lucrative business either. So I think the other thing they really need to focus on is the online initiative. The more they can devote towards internet sales, trying to do something a la Amazon, the better chance they have of staying in longer. But I think profitability is just going to be really hard to come by for them.
I'd like to see them differentiate themselves by the service aspect on the showroom floor. So if you want cheap, you can go to different places. But if you want some advice and to really know what you're buying, you go to Best Buy. They're just not getting that done. It's a disaster in terms of the sales staff.
But if you look at their marketing, I mean, their latest commercials with Amy Poehler, where one of the key messages, the overall theme is one of customer service, but one of the key messages is, hey, we don't make money on commission. We're We're just here to help you make the right choice.
But it seems like maybe they might benefit. I mean, we've talked about that before, the service aspect. Make it something that you can't get online, something that Amazon can't specialize in, for example. So the service side of it, if they whittled it down and almost became like a consulting business to some degree, where if you're looking for someone to help you in installing an entertainment space in your home or whatever it may be. I mean, a resource to contact and to talk with and to get some ideas from that might be something.
Do have that on the tech side with their Geek Squad. Right. Somebody who's local who can actually sit down with you face to face, whereas you're calling some random stranger around the world is appealing.
HH Gregg actually does a good job with their sales staff. That's the name of the company, HH Gregg.
Right.
Yeah. So I don't know if there 2 of those are needed in the world.
Probably not.
But maybe taking a page from their notebook would be a good idea.
Yep. Shares of JCPenney down more than 20% this week after fourth quarter results. And Ron, obviously there are a lot of numbers on the table. The one that leaped out at me was the fact that same-store sales were down a whopping 32%.
I don't know if I've ever heard of same-store sales being down so poorly. Ron Johnson so far is not getting it done. Now, to give him some credit, he did say this was going to be a multi-year process. So
he was right.
He was completely right. It appears it is not going well, though. The boutique concept, creating many, dozens and dozens of boutiques within JCPenney and taking kind of the sales, promotional couponing away, doesn't seem to be what the core customer wants. So he is admitting that he's getting back to the sales. He's going to start running weekly sales. There will be promotions and coupons. So that's good. But I'm just not sure in this competitive environment. Retail's a tough business if JCPenney can turn it.
Well, similar to Best Buy, when you look at the fact that they have 1,100 stores, they have 160,000 employees, isn't getting smaller as quickly as possible, isn't that part of the solution?
I definitely think that's the case. You look at probably take your most profitable stores, maybe your top quarter, top half. You get rid of the rest. I think you can have some of that boutique concept still in the store, but also offer some sale merchandise to the core customer. Maybe you can compete and be profitable under that scenario. The balance sheet's not strong. They're CCC plus, that's triple C plus to you and me, credit rating, the lowest tier of junk. Wow. So the balance sheet is not necessarily there for them to get this done, and I don't know how they're going to access capital, so they're in trouble.
So we've been following the story for almost a year now, and if I go back to their Q2 call, that was supposed to be the bottom, and they said up front it's going to get worse before it gets better. We're not seeing signs that it's getting better. I think it's actually getting worse, and it seems like each quarter that comes on, they're like, oh, we tried this, it didn't work, and we're going to try this new pricing strategy or merchandising strategy, and it just seems like they're throwing a lot of stuff at the wall and nothing's sticking.
Ron Johnson may still have some time left because Pershing Capital, Bill Ackman's company, and Vornado Realty own 40% of the company, and they're still sticking with him and understand the multi-year concept, but they'll turn on a dime. They're in this for a profit.
Coming up, we've got the battle of home improvement stocks and the 25 best companies in America. Stay right here. You're listening to Motley Fool Money. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. Welcome back to Motley Fool Money. Chris Hill here in studio with Jason Moser, Charly Travers, and Ron Gross. Programming note, next week, Motley Fool Money will be recorded live at the Kogod School of Business at American University in Washington, D.C. Woo-hoo. We're doing a taping on Thursday night, and if you are in the D.C. area and would like to attend, drop us a note, radio@fool.com. That is Thursday, March 7th. At the Kogod School of Business at American University. 2 home improvement stocks reporting this week. Lowe's fourth quarter earnings came in better than expected, but the guidance for 2013 was disappointing. Home Depot fourth quarter profits came in higher than expected. So, Jason, not a big surprise. Home Depot shares doing a little bit better than Lowe's this week.
Yeah, I think Home Depot was the winner of the two. They were decent quarters. Lowe's was a little bit less stellar, so to speak. But I do think that these are both good signs that there is some traction, at least in housing. Consumers are getting back out there and buying. The one thing I like about Home Depot and Lowe's, these are two great ways, I think, to play the housing rebound, so to speak, because they're not so levered just to whether housing is good or bad, because they can still benefit from the renters, and they can benefit from people buying homes as well, new home construction. There's always something to get at Home Depot or Lowe's, and always something to do. I like Home Depot better in this case. It's bigger. They're able to bring a lot more of the cost savings down to the bottom line. It's a more profitable operation than Lowe's, and certainly the raise in the dividend and the $17 billion stock buyback show that they are very optimistic of their future as well.
Shares of Priceline up this week after fourth quarter earnings came in higher than expected. Charlie, revenue up 20%. This company's just crushing it.
Yeah, they sure are, Chris. Bookings were up 31% to $28 billion. That's just a huge number. That's people buying hotels, flights, and rental cars through their websites. Earnings per share were up 34%, and they're guiding for another year of 30% growth in 2013. Some of the bright spots for them is the growth in Asian and Latin America. Their core market is Europe, just to put that in perspective, through their bookings.com websites. They just have a huge network of hundreds of thousands of hotels that you can go to their website and get a great deal on.
For the past several months, we've been compiling data and analyzing more than 1,700 public companies to come up with our list of the 25 best companies in America. And when I say we haven't been doing it. I got to give a shout out to our managing editor at Fool.com, Brian Richards, and the whole team that worked on this: John Reeves, Alon Moskovitz, Anand Chakavelu, Dari Fitzgerald, and Chris Weiscarver, basically weighing how companies treat all of their stakeholders and coming up with a list of the 25 best. So working off of that list, what's a stock that's on your radar, Ron?
Well, unlike two retailers we discussed earlier, Best Buy and JCPenney, Nordstrom's knows how to do retail, and it's a fantastic company. Relatively high-end, but great customer service. They pay their workers on average 60% more than the average retailer. Higher profit margins than Macy's and Saks, so they do a really wonderful job. Only about 240 stores, so that they know how to do it right.
Yep.
Unlike we said JCPenney with more than 1,000 stores, so it's just a wonderful company. Not screamingly cheap, but also not very expensive. Just kind of where you think it would be.
And the ticker symbol?
I'm drawing a blank, gentlemen. What is the ticker symbol on Nordstrom's?
It's the initials.
Guess,
it's
is
like
it NORD?
No, I think it's JWN. I think.
That is correct. It is JWN.
JWN.
I get a point for that.
Yes,
Charlie Travers, what's your stock off the list?
I'm going with Google, Chris. It is just one of the most innovative companies in America. And it's not just that they come up with great things like Gmail and search. It's that they make it easy for their consumers to use, really breaking down a lot of the barriers that can be intimidating about tech. And I think that's one of the reasons they're so successful.
And the ticker?
GOOG.
See, Charlie knew the ticker.
Yeah, sorry.
Jason?
I know my ticker, too. It's Under Armour, number 10 on this list. Ticker is UA, but, this is Kevin Plank's business, and that's one of the reasons why I like it so much. He's certainly married to its success. Big competitor is Nike there, but Under Armour's doing a really good job keeping inventory under control, and they're witnessing some gross margin pressure there. But I do think that it's a long-term growth story. The stock is not cheap today, but I think that it's definitely one worth keeping on the short list.
Under Armour's number 10 on the list. Google is number 4 on the list. Nordstrom is number 17 on the list. But if you want to check out the entire list, go to fool25.com. That's FOOL25.com. It's our list of the 25 best companies in America. Ron Gross, Charlie Travers, Jason Moser. Guys, thanks for being here. We'll see you next week at American University.
Cannot wait.
Thanks, Chris.